At the center of this account sits a single figure that puts the entire story into perspective. 34.2 billion Canadian dollars. That is the final cost of constructing the Trans Mountain expansion, a pipeline stretching from Edmonton in Alberta to the Westridge Marine Terminal in Burnaby, British Columbia, which began expanded operations in May of 2024. The initial projection for this project was $5.4 billion at the time it was first proposed. Over time, that estimate rose sharply. What started as $5.4 billion ultimately reached $34.2 billion Canadian dollars. This was financed through public borrowing backed by the federal government. Supporters describe it as a strategic infrastructure investment. Critics, however, called it an expensive miscalculation that triggered years of political disputes across 2 consecutive federal administrations. Yet the project is now operating in line with the original intent of its planners, shifting Canadian crude exports away from dependence on a single buyer and opening access to rapidly expanding energy markets in the Pacific region. Attention now turns to what has actually happened since the expansion came online. The pipeline's capacity increased significantly, moving from 3,000 barrels per day to 89,000 barrels per day. As full-scale operations developed through 2024 and into 2025, the key commercial question became the destination of the oil once it arrived at the Burnaby Marine Terminal. From there, crude can be loaded onto tankers and sent across the Pacific. One option is the nearby U.S. West Coast refineries in Puget Sound, Washington, historically the closest and most frequent destination for Canadian seaborne crude. Another route leads across the ocean to markets such as South Korea, Japan, Singapore, India, and China. These countries host advanced refining systems and import large volumes of heavy crude from multiple global suppliers, including the Middle East, South America, and increasingly Canada. The United States took in about 80 barrels per day of heavy, sour Canadian crude through TMX during the first 11 months of 2025. That level was 25% lower than what it had received in the second half of 2024. By October 2025, based on Bloomberg data cited by Vortexa, as much as 70% of oil cargoes leaving British Columbia were headed toward Chinese ports. In February 2026, Canada's National Observer reported another shift in the broader regional balance. Asian exports increased from 32% of TMX volumes in 2024 to 47% in 2025, when all Asian buyers are included, including South Korea, Japan, India, and Singapore. At the same time, U.S. West Coast refineries that once expected to take a large share of the new TMX capacity are instead seeing Canadian crude shipments move past them toward Asia, where stronger pricing is available. The pricing structure becomes the most important commercial factor in the entire Trans Mountain expansion story. It also reflects the direct impact of trade tensions with the United States on Canada's long-term energy revenues. Before TMX, Alberta's landlocked crude consistently traded at a discount compared with the North American benchmark known as West Texas Intermediate. This gap is referred to as the Western Canadian Select Differential. That discount developed from 2 core conditions. Heavy crude requires more complex refining compared to lighter grades, which naturally lowers its price. At the same time, limited export routes for landlocked supply gave buyers more leverage over pricing because sellers had fewer alternatives. In some periods, that gap widened to $30 per barrel. That represented major annual revenue losses for Canadian producers and reduced returns for both provincial royalties and federal tax income. With the expansion of TMX, that pricing gap has narrowed significantly. By June 2025, the WCS differential fell to $95 per barrel. That was the lowest level since a brief tightening in 2020, and far below the historical range of $15 to $20 per barrel. The mechanism behind this change is direct. Once Canadian producers gained access to Asian buyers, pricing began to reflect global competition rather than dependence on a single regional market. Asian refiners compete directly with U.S. West Coast refineries for the same barrels. Many of these Asian facilities, especially in China, operate advanced cracking systems designed to process heavy sulfur-rich crude into higher-value fuels and petrochemical products. This competition has strengthened Canada's bargaining position and lifted the price received for its oil. TMX is estimated to have increased Canadian oil revenues by approximately 10 billion Canadian dollars in 2024 alone. One analyst described that figure as roughly equal to an additional month of national oil production value. From an investment perspective, a $34 billion project generating about $10 billion per year in added revenue implies a payback period of roughly 3 to 4 years before accounting for longer-term gains. Critics who argued the project was not financially justified assumed that Pacific access would not materially change Alberta's realized oil price. Market outcomes have not aligned with that assumption. The geopolitical dimension of Canadian crude flows requires careful framing, as the pattern carries clear international implications. China has become the largest single buyer of Canadian crude moving through TMX. According to Pipeline Technology Journal, Canada has shipped an average of approximately 207 lower barrels per day to China since the system increased capacity. That exceeds the roughly 173 barrels per day delivered to the United States over the same period. Overall, Canadian crude exports to non-US destinations rose by nearly 60% in 2024, reaching a record 183 barrels per day. By late 2025, Canadian crude exports to South Korea had reached 306 million Canadian dollars over the period since TMX began operations. Before the expansion of the pipeline, this figure had been effectively zero. A January 2026 assessment by the Asia Pacific Foundation of Canada highlighted another structural detail. Japan still sources about 95% of its crude from the Middle East. At the same time, tensions in the Hormuz region have increased concern over supply security. In that context, Canadian crude arriving from the British Columbia coast in roughly 10 days without passing through the Hormuz transit route is viewed as strategically more attractive. In March 2026, Japan and Canada signed a comprehensive strategic partnership in Tokyo. That agreement includes explicit commitments to expand both liquefied natural gas and crude oil trade between the two countries. The Canadian government has been clear about the broader strategic framing behind these developments. Canada is treating its oil exports not only as commercial diversification, but also as a diplomatic instrument for building stronger relationships across Indo-Pacific partners. Each barrel of Canadian crude that is refined in Asia instead of the United States contributes to deeper Indo-Pacific trade ties. At the same time, it reduces the pricing leverage that American buyers have historically held over Alberta's landlocked production. The trade war has intensified these trends, with the Trump administration imposing tariffs on Canadian goods and generating uncertainty in the bilateral relationship. Canadian producers and federal policymakers have had further incentive to expand market access in Asia-Pacific regions. Even before these geopolitical tensions, this shift was underway in a quiet and technical form, yet with significant long-term consequences that are often underreported in mainstream coverage. Attention then turns to the ownership structure of the pipeline itself. The Carney government has stated its intention to divest the Trans Mountain pipeline, marking the next stage in its evolution. Officials have emphasized that this process is being managed carefully to avoid weakening either operational performance or the commercial value of the asset. In a March 2026 report, the federal government stated that it does not intend to remain the long-term owner and plans to begin a divestment process in due course. That phrase reflects a deliberate timing strategy. The government aims to avoid a rushed sale that could undervalue an asset whose financial performance is still strengthening. Utilization rates reflect that trajectory. The pipeline operated at 77% in 2024. It is projected to reach 84% in 2025 and could climb to 92% by 2027. This indicates a steadily improving revenue profile as Asian buyers deepen long-term supply relationships with Canadian producers. It also reflects new refining capacity in Asia that is being optimized for heavy Canadian crude grades. A divestment executed at 84% utilization in a strengthening market would carry a significantly higher valuation than one conducted at 77% in an earlier stage of stabilization. The federal government is aware of this timing calculation. Meanwhile, the asset itself has evolved substantially. The 34.2 billion Canadian dollar pipeline, originally acquired from Kinder Morgan in 2018 for $4.5 billion, became far more expensive due to regulatory delays, geopolitical pressures, and construction challenges. It now operates as the only direct export route for Alberta crude to Pacific markets. The system is generating revenue, narrowing the Western Canadian Select Discount, and strengthening trade relationships across the Indo-Pacific region. The overall outcomes are now measurable. Canada invested $34 billion in a pipeline that is redirecting crude flows from U.S. refineries toward Asian refineries. Roughly two-thirds of TMX exports are now directed to Asia. The WCS differential has narrowed by 5 to 10 US dollars per barrel. Annual revenue gains are estimated at about 10 billion Canadian dollars. Canada's customer base now includes China, South Korea, Japan, India, Singapore, Brunei, and Taiwan. This is the final position of the system, a large infrastructure investment producing the financial and strategic outcomes it was designed to deliver. The next phase will be defined by how Canada manages ownership, market expansion, and long-term energy diplomacy in the Indo-Pacific region. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.